Right. So before I give it to Nikhil and to actually go into this session, and you can hear from Jens Lapinski, I just want to give you a brief introduction to DoDash, just a brief one, and then we go into the session. So what is DoDash? What is it about? I think usually it's good to start with a problem, kind of like what is a challenge that many startup founders face? And that's actually the access to capital and investors, and also managing the whole process, going through it, what do investors want? For that, we with DoDash have launched our DoDash Investor Relations platform that just happened a couple of weeks ago. And you can join that platform to help you actually go through the whole fundraising process and help you become investable, reach out to the right investors, manage your due diligence, your whole outreach, and also do your updates to investors. Have a look at the platform. It will help you for all stages of your startup fundraise. So just go on dodash.com. We also have regular demo sessions. I will share a link later throughout this session. We're also supported by quite a lot of different partners. So you can see them here, also for the ones below, and some more also.
IT was in.
Please make sure to mute yourself if you come in.
IP-Recht,
so Dirk, I just muted you. Please make sure that you mute yourself. Yeah, thanks. You can ask questions into the chat. So again, as I just said, we have a lot of different partners which support DoDash and our work. And if we also have a couple ones who provide different startup credits, discounts, like AWS, HubSpot, Freshworks, which just had an IPO, and other ones as well. So if you're interested in these, just let me know. We will also share the information. We have a featured deal, which is Data Vault. I will share the details very soon. It's a tool for secure data sharing and collaboration, which enables you to take your sales and marketing game to the next level by actually knowing how your documents are used and take it to the next level. If you have other questions on DoDash, just reach out to me, michael@dodash.com. And with that, I would give it to Nikhil to introduce our speaker and take it from here. And yeah, let me just put you on top of the screen so that you're on.
Thank you, Michael. This monthly event that I do, welcome to my Investors Lounge, Jens. It's such a wonderful pleasure to have you host you here on this particular show, this edition. Usually, I don't like to introduce my guests. I would rather like my guests to introduce themselves because they do a better job than anybody else. So over to you, Jens.
Thanks for having me, Nikhil. So I'm Jens. I live in Berlin. I make about 20 angel investments per year in early stage technology companies. I typically invest 100,000 euros initially and then happy to invest more later on. Once I'm invested, I coach the founders through for about a year to the next round of funding. We can talk later about what that means or doesn't mean. Before this, I spent a long time living in the UK. I did a PhD there, built some technology, then went into a startup, then started my own. Then I helped set up the first startup studio in the UK, which turned into an operational VC firm. So that was later then called Forward Partners. I then left the UK to bring up the children in Germany, moved to Berlin. Techstars asked me to set up their local office here, and I was the managing director of the German fund for 4 years, made 40 investments in that time, helped build out the European operations. And after 4 years with Techstars, I decided to leave and set up my own angel fund, which is called Angel Invest. We've now invested in 59 companies over the last 3 years. Many of them are doing really well. Companies like Rasa or CoachUp or Everphone, Usercentrics, many others. And we just look for super ambitious teams that do something that nobody else is doing, and maybe it's already working a little bit. And then we're happy to help them, coach them through for about a year. We try not to tell founders what to do. We just try to help them, do it really well. That's sort of the mantra that we have. Right. And that's sort of me. I don't really do anything else apart from making these investments. I mean, at least not professionally. I also sit on the advisory board of a Berlin-based VC fund, and that's sort of what I do.
That's a lot that you already do. But you didn't tell us any fun fact about yourself. Tell us about you as a person, something really funny about your pet peeves and what really, gets your goat.
Oh gosh, I like puzzles. It's one of the reasons why I became a natural scientist, and then went into investing. Is like all these multi-dimensional puzzles, right? Complicated, fuzzy systems, and figuring things out and trying to figure out, is this something that could work? What goes into that? What do I have to do now to maximize the chances of that company succeeding? And how can I help the founders best, right? So that's sort of like my intrinsic motivation is just I really like figuring out complicated puzzles. That's really what does it for me. Apart from that, I sort of really like helping people. That's sort of how this sort of comes together for me. Apart from that, I don't know how funny I am or not. Sort of how many fun facts there are. Fun fact might be when I was 12, I broke my back. I'm super happy that I can walk. That's sort of like I have very little aspiration to become a weightlifter or do anything like that. I think that incident changed my the way in which I view the world in quite a lot of ways, if you like, right? Anyway, so yeah, that's sort of a little bit more about me, maybe.
And how's been your pre-VC journey and post-VC journey like? I mean, if you were to draw a comparison between the two.
Yeah, I mean, so when you do a startup, there is an initial phase where you really try to figure out exactly who your customers are, what problem they have, what the job to be done is, and what you have as a value proposition, and then how you fix that, right? And that process takes, I don't know how long it takes, it's quite variable from company to company. And then you basically you set yourself and you say, okay, that's it, and we're going for that now. And after that comes a multi-year slog of execution, right? where it's about company growth and bringing all of that to life. But the in principle decision that you've made is sort of like you make in the first year. Yeah. And so as I said before, so because I like this figuring out of things, it's like for me, running a startup is kind of boring in the sense that I do the interesting bit for a year, and after that I become increasingly bored with the whole thing. That's sort of how I have felt that when I was on the operating side. And then when I went into the startup studio and into Techstars and now Angel Invest, which is like a gradual slide from operating more onto the investing side, I just spent most of my time. I mean, if I look at how I spent my time in the week, I spent a lot of time talking to founders whom I don't know. And then I spent a lot of time talking to founders that are in my that we have invested in, right? That I'm currently working with, and it's just a continuous exercise of trying to figure out, number one, is this the right kind of company for me to work with? Should I invest in this? And then on the side where we have invested, what question should I ask? Like, what's the most helpful way? What can I do for that team right now that would impact them in the best way and really help them execute better? Yeah. And that's sort of those kind of questions is how I spend vastly more than half of my time on. And so that's obviously continuously intellectually stimulating, and it aligns really nicely with sort of my personal interests, if you like. Yeah.
So this is very interesting. I mean, you said that you were an operator, and then of course you started supporting the ecosystem. Through the ecosystem, you started actually investing in a lot of companies, and then you set up your own angel fund and also serve on the board of VC fund. What's the funniest pitch that you've ever heard?
Funniest pitch? You mean the funniest pitch that I eventually invested in? Because there are quite a lot of things where I laugh, but I end up not investing. I'm not quite sure those things correlate, but.
So let's take it. Let's hear both. Something.
The funniest that I don't really mentally look at. I look at way over 1,000 pitch decks a year. I don't want to point out anyone where I think that was funny and then I ended up not investing in it. I think that's sort of not really fair, But because it's quite that's not right. of all the companies I've backed, what was the funniest pitch? Well, I mean, I don't know whether it's the funniest, but it's the one, there are companies where I invest where I think when I first time look at this pitch, I think I can't believe that this is a thing. It's so surprising, or I was like, really, this exists? Like, unbelievable, right? Why should this even be is this really a thing? So, for example, I've invested in a London-based company that's in the business of helping people deal with porn addiction, right? I don't know. So I looked into this. Turns out this is actually a huge thing, particularly for young adults, particularly during COVID. And I just became, I was really, I don't know. I looked at it and initially thought, what is that? Is that even serious? Should I really look at this? And then the more I looked into it, the more interested I became in this whole space. And I ended up investing, and the company is doing phenomenally great, right? It's a company called Remojo out of London. So, and I just always think this is so delightful that I don't have this thing where I think I know what the world needs, but the founders do. I think it's just great because they find all of these problems with the world, right? And they say, I know these people, I see what problem they have, and I figured out how to help them, and this is how I do it. Right. The Jack who runs that company has done a phenomenal job at figuring this out, right? So, which is why the company is working so well anyway. That was maybe the most, one of the most surprising, I think, no, funny is the wrong word, maybe it's one of the most surprising companies that I ended up investing into, and I'm super happy that I have invested less than a year ago, actually. Yeah.
So tell me something about this. This is a very interesting situation, and I think a lot of people really get to understand. You were not alone when you did that. I mean, you ended up investing in a Mojo, but generally, you must have passed a lot of companies. That's what we call today as anti-portfolio.
Yeah.
Bessemer Ventures very openly publishes their, I think part of a very, very extremely minuscule part of their entire portfolio. But what about you? What is your regret capital, if I may ask you?
Oh, I have, there's a number of companies where I passed that are doing really well. Yeah. And it's typically, almost always because I think incorrectly about the competitive situation of these companies. Uh-huh. So I have a tendency to overestimate competition along some vectors. So there are two companies that I passed because I thought they were competing with companies that were already in my portfolio. And on paper, that might even be true, but in reality, it's completely untrue. So those are two companies that so the funny thing is, if I had invested in both of those, it might have actually negatively impacted the relationships with the two teams that I am invested in. So I'm still not 100% certain whether I should have invested in them. Then there are other companies, particularly in the fintech space, where doing really well. They have so many competitors, but these markets are so vast that the competitors are de facto irrelevant, right? So it's just about execution. So there are a couple of companies that I think they've grown so fast and they're so big now. Why didn't I invest in this? And I thought, well, because they have 10 competitors that are doing exactly the same thing. It just turns out it doesn't really matter at all. And this is an unusual situation. So I'm not my fintech exposure is there, but I'm not a specialized fintech investor, right? So it's these kind of things, and that's sort of you look at all of that and you try to learn from that, So maybe say, okay, unless there is something that's immediately directly competing with a portfolio company, I might still want to invest. So I've done that recently, and that was a really great decision. And then on the other side, on the fintech side, I've just become less sensitive to competition. Or in some very large market situations, I've just become much less sensitive to competition.
I mean, it's quite interesting that you talk about this. Google, for one, Google already had Harish, can you please mute yourself? Marcus, can you mute? Yeah,
I did.
Yeah. So we were talking about Google. I mean, Google back then, you had so many search engines like Ask Jeeves, and I don't know, I can't even remember. It's been such a long time, and nobody believed that Google will be what it is today. Of course, there's been series of pivots out there. Similarly, we are using this platform called Zoom.
I would have never invested in Zoom. I guarantee it. That is almost impossible for me, because I'm sort of more of a I look for more eclectic things, right? Things that are really different and really new. It's sort of the way in which I look at it. And Zoom is a pure execution play. They just did video much better than everybody else. But funnily enough, the reason why I ended up using Zoom a few years ago was because it was noticeable that the processor load of Zoom was significantly lower than of all other video platforms.
Absolutely.
Right.
Absolutely.
And because of the way in which they have encoded this. So I don't know whether, so I think it's unlikely I would have invested in Zoom, to be quite frankly honest. But I always ask myself, so like, is this company really so much better than the whole competition? Is that really going to make any difference to the customers? Yeah, that's significant. And with Zoom, it actually was, because even before the pandemic, I've made most of my investments just via video. And I've got days where I sit here for 5, 6, 7 hours straight in front of video. And, try to do that on something that's not Zoom. And after 3 hours, your computer is so hot, you can't continue.
Absolutely.
Right?
Absolutely.
So, it's at least how it used to be. So when you see that also as an investor, you say, wow, that's really standard. That's like, it's noticeable, right? It's significant. So then I think it still takes quite a lot of conviction to then say, okay, because of that, this company is going to corner that market. I think that's kind of like a relatively big leap. Yeah. So I don't know. Yeah, but it's difficult. Nobody can see the future, so it's difficult to make these kind of judgment calls.
So would you define it as innovation?
Yes, because innovation is the process of introducing change. And I think without, proper video platforms, the way in which we do these things now, that wouldn't have happened. So they're definitely innovating. Have they invented, invention is the creation of something new, and they haven't really created something new, right? They've added it, they've improved it, something that already exists, and turned it into something that people have a preference for. But that is like, if you think about it, I like to use the car analogy, right? So like maybe a BMW is a better car, and a Skoda is a cheaper car, and then a Tesla is a totally different car, right? So they build really the premium Benz type version, right? Because
Right.
Zoom is really in no way different from a Skype or from many of the other video products used to be. I think we're using Blue Jeans at Techstars at some point, and can't remember how many other Whereby and how many other tools I've trialed, right? But they just built a better version of that, the one that worked significantly better, which is also similar to what Google did, although in their case, the product leap was much more significant.
Right. So then it just brings me back to one question, and this I would like you to answer it in two forms. One, it is specific to Germany, Europe, and then probably from a global perspective. So what are the entrepreneurship ideas that you have encountered recently which deserve a bit more attention, and in this order of magnitude?
In what way do you mean that? Like conceptually or specific companies or specific?
No, conceptually, and of course, you can, if you want to name specific companies, go ahead, do that. But from an idea standpoint, because, we talk about initial inception is always idea, but, that's only 10% of the problem.
Yeah. I think one thing there are a couple of sort of trends that I am actively investing in, if you like, if that's a helpful way to answer the question. So one thing that I find fascinating in the fintech side is a trend that I think of as I give you software and when you give me your transaction. So you're giving somebody a piece of software so that they can work better along whatever dimension. But in order to help them do that, you need to take charge of the financial transactions that they're doing. And I think the reason why this is interesting is because then you don't have a rat race to the bottom in terms of transaction processing cost, but you're actually differentiating yourself much more on the software side. I think that's also quite defensible and quite sticky. I think that's a really interesting macro trend. And I see this a lot right now. And there's some companies that are ramping up revenues extremely quickly with that approach. So that's one. Another one that I think of is people are starting to buy software to manage their software. I also really like this, right? So much software, it's so complicated. Oh gosh, I need some more software to manage all my software. There's a lot of that happening right now. I think these companies are also super sticky. This also makes quite a lot of sense to me. Another one that I really like, I see quite a few startups that are building real technology right now, typically involving hardware or real chemistry or real machinery that very, very few investors dare to, touch. And I think there's some extraordinary companies that have the potential to be, 10 billion plus in size in terms of market cap within a short period of time that most investors just ignore, right? I love all of that. And there's quite a lot of environmental technology in that in many different ways. So we invest in those kind of things too, And those three things in combination, that's quite a significant percentage of the kind of things that I'm currently really excited about. And apart from that, I just love everything that's sort of eclectic. Everything that's super unusual that nobody else does. I just, whether that's real technology or not, but I like all of that. I think sort of zooming out from I think the way I think about the investment markets is I think Europe and the US from a venture capital investment perspective are joined at the hip. It's actually one market. It's the same investors that invest across both. It's quite fluid. I think there's very little difference. Outside of that, I think all of the other markets are really separate. So you have a market in China, although to what extent that will exist in 5 years is a totally different question. Then you have a market in India. Then you have the whole Southeast Asia market. You have a LATAM market now. You will have an African investment market, right, or a Middle East one or whatever. They're all super separate markets, and these markets in terms of the teams that invest in them are very, very separate from each other. Yeah, and I think in terms of the maturity, there are some markets that are more developed than the others, and what is already sort of the LATAM market is a good example of that. Many of particularly the fintech things or whatever that you see in other markets that work well, there is, they're doing the copycats down over there, which work really, really well. And I think it's a fantastic way to grow an ecosystem, right? Because you take something that works, you do the geographic transposition, and then once these companies are there in 5-10 years, you will have a lot of, because there will then be so many people who know how to build technology businesses, they will then start to do many more things that you call innovative, right? So things that are really different from taking something and doing copy paste. Yeah, this has also happened in Germany 10 years ago, and we'll see this everywhere else too. I think there are no real differences in many, many countries in Europe when it comes to venture investing. A lot of European venture capital is quite across border. All the late stage funds invest in all of the countries. I think there's very little difference. I think there's some countries that are really behind in terms of the development of their local ecosystem, but it's really more down to local politics and a bunch of other things as opposed to, any significant other differences.
Gotcha. So, what we're going to do now is I'm going to ask my colleague Parul also to ask you a couple of questions. And then we're going to move on to audience question. It is, we cannot take all the questions. We'll try to go by sequence, whatever we receive in. So audience, go ahead, start asking your questions on chat. And I'm going to hand over the stage to Parul. Parul, go ahead, ask a few questions.
Thanks, Nikhil. Thanks for giving it to me. Jens, I would like to, for the benefit of the audience, because we usually get a lot of early stage founders on these kind of sessions. I think you made a very important point earlier on that you pass these opportunities because the market competition, the market opportunity was not very clearly defined for you. So what are the mistakes or omissions usually founders do when they're defining those, competition? What is the definition and how should they keep on refining it? Of course, they need to start somewhere. I would like you to kind of just dial into those basics so that it can help the investors to assess.
We can do that. I think just to clarify, I don't pass most of the time because of competition. It's just my anti-portfolio lives in the I passed for competition reasons bucket. Or almost all of them are in that bucket because I passed for competition reasons. So that's sort of that. The reason why no, it's just it's important because if the question is really much more, where do I see the most mistakes that founders make? Which is a slightly different question because
I would like you to kind of perhaps I think competition definition is sometimes a tricky part, right? Because that kind of helps you define your business model. Also, sometimes that helps you refining your product strategy, go to market, sometimes how people want to position themselves, the narrative they want to build, perhaps also benchmarking their valuation, which would actually be a segue to my next question. So I'm kind of trying to understand from you, like going back to the basics, how should you look at competition and how should you define that market opportunity?
Yeah, so I think there are some, you mentioned the word positioning in the context of this. There are some really good books that people, if you really want to clue yourself up properly in the audience, that there are a couple of books that are worth reading. One of them is called Positioning by Al Ries. And then there's another book called Play Bigger by Al. His first name is also Al, and I just can't remember his surname right now. And, they talk about, I think that this is going to take a little longer, but we're going to get to it eventually. So there are more brands that try to get into the brains of customers than there are words in the English language, right? The brain cannot deal with all of those words. Yeah, it's just impossible. So what the brain does, the brain creates a shortcut and it creates a couple of words and then it attaches the brand to those words. Yeah, and this is called a category. And whenever there is something that people really want, the brain makes a category, people talk about this category, right? And then the name of the number one player in that category becomes synonymous with the brand. Oh, I need a search engine. Oh, it's Google. What's Google? A search engine. What's a search engine? Google. There's no difference. It's identical, right? Every large company occupies that thing, that category. You cannot have a big company without occupying a category, right? And in every category, there's typically one company, maybe two, but typically it's one that occupies that category. So really, when you try to build a big company, you're trying to create a new category that you can stick into the customer's mind. Yeah, and it has to be you that dominates that thing. And if it's not you, then it's somebody else. And all of the profit in that category will accrue to the number one. And the number two will break even and everybody else will get almost nothing. And that's how that works. So if you want to basically position yourself into a category that you create, right, you need to differentiate away that category from all other categories. And that category better be large and you better have the opportunity to become the number one in that category. And the problem is this is a pretty tall order. It's almost like, hey, I've got two people here. There's two people in the dog, and I'm going to create this $10 billion category, and this is what this is called, and we're going to make this happen. Everybody else is not. And that's difficult. This is also why, from an investment perspective, it's where you get it wrong, particularly when you're early stage and you have almost nothing to go on. You would just say, oh, I don't believe this team can do that. Or you might say, oh, I see 15 other teams that are trying to do the same thing, and I can't pick the one that's going to make it. I just can't, I don't know how to choose because this will only become apparent at Series C stage or whatever. Yeah. And I don't dare not try to pick because I don't know who's actually going to win, and I don't want to be in that kind of competitive environment, right? So that's sort of how I think about competition. This is why I like investing in the oddball type companies a lot, because, you know, if I'm right and this thing actually works, then they are the only ones going after that. So that's a much more forgiving environment. Yeah, because if you're up against 10 other competitors immediately, then you really have to have by far the best team, and your specific angle that you're taking into the market really has to be right. Yeah, and that's sort of the burden on the team quality and the execution quality just goes up exponentially when that happens. And that's why I personally don't, as a super early stage investor, I very frequently don't invest in that. It's just easier to pick off some of those competitors in later investment rounds and at higher valuations than what's possible for me. But that's why, in a sense, for me, my trick has to be really team evaluation to a certain extent versus, you know, competitor evaluation, because if I'm stuck on competitor evaluation, it's really difficult for me. Yeah.
Absolutely.
Sure. Now, thanks for clarifying that. I think I just wanted to kind of get that perspective out. The second question, which was a segue to this one, was like, founders are a bunch of optimistic people, and so are VCs, because like you yourself mentioned, you're playing for that one big bet and you want to get it right. And that's why you kind of play for oddball. Now, after the initial meeting, when you meet that oddball and you're really excited and the founder is really excited, there is a time when those conversations kind of become tricky, when it comes around the conversation around valuation and the investment check. And how should a founder tackle that, you know, because there is this dilemma from an investor standpoint. They can see this to be really crazy or, you know, arrogant or whatever. And from a founder side, they might think that, okay, I'm giving away my ownership and they don't value me enough. So how should that be tackled from an early stage founder? And also sometimes people look at, raising a big round. Should they think about raising a big round? Should it be or smaller rounds are effective? Like how should they think about planning the fundraising?
Yeah, I mean, I spend a lot of time discussing that with the teams where I'm invested. The answer is quite multifaceted. I mean, going back to the question that you asked first, right? So you discuss the people are interested, how do you get them across the line? I think the number one advice, there's actually two separate pieces of advice. The first one is quite short. Never tell anyone that you're looking for a lead investor, ever. Lead investor is like a toxic bomb. When you throw it into a fundraising discussion, that discussion will probably die. Because either everybody who could be a lead investor is turned off by that, or everybody who is by definition not has the perfect excuse to say, hey, why don't you get back to me when you have one? Yeah, so you definitely do not want to ever mention the lead investor phrase in any discussion that you ever have. That's sort of rule number one. The second one is the way out of that is you need to work with, conditional yeses, right? Under what conditions would you be happy to invest in my company? Oh, I don't know. Okay, well, what do you typically do? Oh, typically, what is the typical check size that you write? Oh, 25,000. Oh, okay, great. So, what needs to be true? So you write the 25,000 check. Yeah, I never invest in rounds that are smaller than 500,000. Oh, okay, so the round is at least 500,000 in size, and it's like, and then I want to have a lead investor. It's like, okay, what does that mean? Oh, I want to have a VC in there. It's like, okay, but then you might fall out. So would you be happy if it's just a number of high quality angels? Yeah, that might be okay for me. I've done that as well. Okay, so basically what that means is you want to have a round of 500,000 and then you write 25K. Is there anything else that you need? Yes, I want to have preference shares. Oh, you want to have preference shares. Okay. What's the liquidation preference that you want? Oh, I want to have a 1x non-participating. Oh, okay, great. Well, is there anything else that you need? I want to have information rights. I want to get monthly update emails. Okay, you want to have monthly update. Is there anything else that you want? No, that's it. Okay, if all of those things are true, are you in for 25K? Yes. Okay, great. Thank you very much. Great to have you on board. Let me write a follow-up email. Yeah. And then basically I can confirm everything that you've just told to me in writing, and then you can, reconfirm that. Now, the interesting thing is, what has the founder agreed to? Nothing. Zero. So the investor has committed to invest 25K, provided that a bunch of conditions are true, but the founder has committed to nothing. They haven't committed to anything. But they've got to commit. Can I use your name for further investors that you've committed 25K? Yes, you can. Great. Whom can you introduce me to? Who's a good co-investor? Whom do you like? Oh, I've got 3 friends that frequently co-invest with me. Let me introduce you. Right? And then you build from small checks to bigger checks. You build your rounds like that. Yeah. And that's how that works. And as soon as you mention lead investor in any of those discussions, that investor will go away. So never say that. Yeah. So those 2 things in combination: avoid lead investor discussion, and then try to pin people down on a conditional yes. And then once you've got enough together to do a round, then you tell people, yeah, look, it's actually not a 500K round, it's a 1 million round. And the valuation that you mentioned, yeah, well, we're doing it on a 4 million pre, but there's so many cool investors involved. You pick the right company. It's great to have you on board. Very few people pull out at that point. And that's how you sort of manage an angel round really well.
Yep. I think that was a piece of golden advice there for the guys who are listening in today. So that was awesome. Thank you for saying that. I just want to ask you one thing. You mentioned you go through 1,000 pitch decks, approximately minimum.
Yeah.
Do you ever, I would like to know, how many emails do you have in your inbox right now and how many LinkedIn messages? Have you ever had 0 inbox ever?
Yeah, several times today.
Wow. So what is your productivity hack? That is something I would like to know.
Single touch.
Okay.
It's just you're only allowed to touch an email once in your life. And then it needs to be archived.
Okay.
That's the only way in which this works. So you read it, you action it, it's gone. Next. It's the only way you can do it.
It's
because
our priority.
so either you just archive and do nothing, or you reply and archive, or you whatever. It's very rare. I've got a separate email address that I forward complicated emails to that I have got no time to action. And then it lives in this other inbox that I go through when I have time. But typically it's a single touch thing. And that's sort of the most important part of that.
That's an awesome piece of advice, basically. Have a don't do list. Just cut out the work that you can't do. Just don't decide.
The work comes in when you continuously have to, you looked at this or you put it away, then you have to read it again, then you have to think about it again, then you put it away, then you have to, what was this again? I can't remember. Then it's like all of this extra time that you spend because you didn't quickly action something. It just takes a lot of time. And if you don't do that, you cut out 60, 70, 80% of your email time, because you force yourself to really get things off the plate and get through the emails and just get them done. That's sort of the most important. That's sort of the most important thing for me. I then also have quite a lot of shortcuts that I have programmed that basically I just type a couple of keywords or type a keyword, and then the whole parts of responses appear. So because there's so many things like that I say over and over and over again, and it's just faster if I don't have to write the whole sentence. I just write a shortcut and the sentence appears. It's just saves me time.
Awesome. I'll hand it over back to you, Nikhil, now to take the audience questions. Thank you, Jan.
Thank you, Parul. Jens, there are like a barrage of questions out there. So I'm going to put you in a bit of a spot, if you permit, with your permission, though. Yeah. That I'm going to ask you to, so that we cover as many questions as possible.
I'll keep the answer short, yeah.
Absolutely, in one line, if possible.
Okay.
Yeah. There's a very innocuous question which I see, which is that there might be several different startup selections of the investors, but what are the common criteria? I'm not sure if the question is clear enough, but whatever you made of it.
What are the common criteria for me to say yes or to talk to a founder, or?
Yeah, I think something on
okay,
those.
So
and if you don't understand the question, you can
okay, so the reason why I talk to startups when they contact me is typically because I haven't seen what they do before. Or there is some unusual quality about the email. Yeah. The reason why why startups fail is because either the team fights or they can't figure out what customers want, or because they can't get it to customers, can't ship it to customers. Yeah. So if you can figure out those three things, your startup is very unlikely going to fail. Yeah. And those are the three primary things that investors try to avoid. And then they're looking for scalability, meaning scalable model, defensible, lack of competition, highly financeable by other investors, those kind of things, you know. So, and if you're an experienced investor, you look at something and it's an automatic evaluation along all of those criteria. Yeah. And you try to just, you know, yeah, 7 things look, okay, let's talk. It's interesting. Does it check like very quickly all of those boxes? Yes. Okay, let's talk.
Got it. There's this very interesting question which has come from Hamdi. And this is about if the business is CapEx heavy, so what kind of attraction would you expect in such a situation?
It's difficult to get this funded by European venture capitalists. They hate asset heavy. Look for money from family offices. All
right, that's a very valuable advice. Then there's another question from a gentleman called Nabil. He runs a robotics startup. Do you invest in Pakistan? If not, why?
I invest in Europe because I know Europe. We know a very high percentage of the venture capital investors in Europe. We understand what they look for, and I can then also practically coach the founders in a direction where I both know that their businesses will perform and they will be highly investable by follow-on investors. And conversely, about the rest of the world, including Pakistan, I don't know what Pakistani customers want or need. I have no clue, and I have no idea who is going to do a follow-on investment in Pakistan. So I couldn't actually functionally really help the companies. I wouldn't be able to choose, and I wouldn't be able to help effectively. And it's many time zones away. So my coaching would be very difficult to do practically. So it's just, I wouldn't know how to do it. So therefore I just do what I know how to do. And that's why I focus on Europe. Yeah.
There's a very interesting question from Suresh Babu, which is that he's got experience in body construction, automobile body construction, and now getting into electric vehicles. How can he get help? I think it's a similar question like CapEx heavy, I would imagine. What do you think? How could he get help?
It's a good idea to talk to founders who run businesses in your region with a similar business model and ask them how they did it. It's probably the best generic advice I can give with regards, because it's applicable to, it's probably generically a good idea to do that and ask people to mentor you and to help you. And you will have a conversion rate. If you ask 100 people to help you and mentor you, you'll probably find 10 to 20 who are going to do that, you know. So it's just Techstars or whatever, you know, other organizations try to shortcut that with mentoring programs. But at Techstars, when you meet 100 mentors, people consistently walked away with 5 to 15 mentors, right? So that actually helped them. So I think it's a good idea to do that.
Awesome. There's a very interesting question from Abdul, and I think this is going to be slightly a curved ball, if I may say. So what are the questions you hate the most during an investment pitch? Investment discussion, I would imagine.
The questions that I get from founders, is that the...
Yeah, the questions which you hate the most from founders.
I don't know. They can ask anything. There's none that I hate. I don't know. So, there's never. I don't really hate any of those questions.
Yeah, that's our job to answer those questions, right?
That's right. No, when I talk to founders, there is always 10, 15 minutes at the end, or maybe even more, where the founders can ask me anything they like to ask me. I just find it curious how there's sometimes there are founders who don't want to ask me anything. And I sit there and think, okay, so you've got 15 or 20 minutes of my time. So ask me, how can I help you? what are the things if you want to make use of me in coaching later on, start now. Like what are the kind of questions where you think I could be helpful, and that then results in interesting discussions, right? Yeah. So, but the founders can ask me anything.
Sure. There's a question from Maxim, and he's asking that, is there a possibility that investor can be interested in investing purely in an idea, no MVP, but with a clear schedule of development plans?
Yes.
Great. It's going to be hard sell though.
It's, unless you are, let's just say, investors need conviction that this plan is going to come true. So there are two ways in which you can develop conviction. Either the founder has done it before and you know that they can do it because you know them and you know their execution capability. Right. And or the plan that they present is just so incredibly well thought through that, you're just blown away. I made an investment like that earlier this year where both were true. Both the previous experience of that team and the precision and the depth with which they had thought through what they were about to do it was incredible. So in that call, I didn't even have to think about the investment. I said yes immediately. I think the next day I didn't have to consider it at all. It was a super easy decision.
But that's because of the level of intimacy you had with the.
I didn't know that team, and it was even a cold inbound. Okay. One of my friends had invested in them, or committed. I can't remember, to invest, or he mentioned them to me, to them. So they reached out, and I knew of the company they had started before, and I didn't know them at all. I just knew that. But when they then presented what they were about to do, it was the quality of that plan and the work that they had put into it was amazing. So, and I just thought, wow, okay, that's a great team. This is a really interesting space they're in. The level of work they have put in to really figure out how to do this, and the things they've already figured out along the way, that's really quite impressive. So I thought, okay, I really would like to work with that team. Yeah.
Perfect. This is amazing insight. There's a follow-on question to this one, probably from some other gentleman. He says, any specific tips to the people who present you with just an idea, pretty much a presentation file?
Same answer. So let's just go back to what I said earlier. If you have a strong team, yeah, and who are the people on this team? What have they done before? How do they know each other? Is this a great team to work on this problem? What have you figured out about the customers? Yeah, not the problem, but the customers. Who exactly is the customer for this thing? Be precise, right? It is this kind of individual in that company, right? And they have got a very specific problem, and the value proposition, and then the job to be done is this, and therefore our value proposition is this. And there are 17 companies that have tried to solve this, and they've all gone wrong because they all did this wrong. And we figured out this is the wrong way because the right way has to be different. It has to be like this. And we tested it in interviews, and everybody told us that's it. And that's what we're building now. Do you want to give us money? If every pitch was like that, I would probably fund every pitch. No, but they aren't like that because the founders haven't put the work in to actually really crystallize this out. Yeah. And you don't need to have, obviously, it's better if the product proves that all of that is true, but it's not strictly speaking necessary if the depth of the investigation that you've done is deep enough so that you can really describe things in such a way that the investors know, okay, you've really figured this out. And I believe on the basis of the team that you can deliver the solution, which is similar to the case that I described earlier, right? Great team, really figured something out. I believe they can do this, and they've now done it.
That's actually, it allows me to toot my own horn for a very short moment. And that is one of the premise of DoDash, the investor relations platform, that we are constantly calibrating companies on the 5 dimensions, which are team, timing, traction, technology, and TAM. And of course, there's an expansion of that, also expanding TAM, but that's usually applicable for late stage. And the beauty is when you are putting in the information, or when you're playing with the system, the needle moves north or south. And on top of it, we've kind of added another layer of it, which is we call it as startup investability quotient. It's like, a Morningstar rating for startups. I think it would be very interesting for audience to check out. So then there is very interesting question. Can you give some tips for AI solutions providing startup in terms of growth and stability, as it is a little confusing for an end user to understand the difference between AI product and AI solutions provided for the product? I mean, that's very esoteric for me, but I don't know how you feel about it.
It depends on who your customer is, right? But I think maybe the question asks whether, look, there's a difference whether you're a technology provider or whether you're a solution provider.
Correct. Right? I think that's what he's trying to ask.
So if you're selling, let's just say you're selling an AI solution to developers, which is, those would be the consumers of the technology effectively. Yeah. Then the way in which your technology works and how the developers who are using it then use that as a product matters a great deal. If you're a solution provider to end customers, the end customer wants the product to work. It wants it to deliver not technology, but the end benefits of technology. And there they don't really mind what's under the hood so much. They just want it to work. And that I guess that's sort of the key difference, because whether it says AI on top or not, I mean, who cares, It's just a self-driving car just needs to self-drive. Nobody really minds what's doing it,
And not get a skill.
That's right. That's the core metric. But how the software internally does it, or the sensors, or the chips, or the whatever. It's just nobody will know how do you know how your car even works these days? As complicated as they have become, right? So I have no clue. I just want them to drive. I want them to work or whatever. So I don't know how it actually works in detail, and I don't really mind either.
There is one very interesting question, Jens, and I think I would love to pick this up. There are a lot of startups who raise capital through crowdfunding, and they have more than 300-400 investors on their cap table.
Yeah.
How do you perceive this as an initial investor, as well as, probably how do you see it playing out in the next higher up rounds?
I think most of these crowdfunding platforms bundle this up, so these investors actually have no voting rights. There's typically, depending on the country, this is handled differently, right? But they either are bundled in an SPV, or they are they're managed, it's held in trust, or it's basically power of attorney and things like that. So, there are even some funds that are structured like that. So where the fund invests, but then the final beneficiaries immediately appear on the cap table. I think it's more, if it's pooled like that, I think this is not a problem for investors, because there is just one person who is responsible. If you have that many investors and there is no pool, you're probably depending on your jurisdiction, you might be in real trouble. Because if you need all of these people to sign a piece of paper so you can do something, this is going to be incredibly difficult.
Absolutely. And that's one of the reasons why not very many investors invest too far away from their jurisdictions.
There's also tax reasons for that, or tax like in UK, investors will only invest in the UK because they get tax benefits, for example.
But isn't it true only for the early stage investors, not the late stage?
Right. So venture, it's typically the tax breaks are for individuals in their own. So when a German person invests in a German startup, they have tax benefits, but that obviously only works when you get taxed in Germany, which means it's German residents, who have the tax benefit. And the same is true in the UK. And then but everybody who has a structured fund they're typically not eligible for those kind of tax breaks. So they are more constrained by who their investors are. Meaning, let's just say if I'm a UK fund and I raise money from the UK government, the UK government will tell me, oh, okay, you can only invest in the UK. Or when I take money from the European Investment Fund, they will say, oh, you can only invest in the EU, or a percentage of the money can only be invested in the EU, and there's all sorts of restrictions around that. And that those are the kind of things that constrain investors. The other reason is just practicality. German investors understand German companies, and then you say, oh, why don't you invest in a French company? All the contracts are in French. It's sort of exclusion by language to start with, So that's sort of that's sort of how some of those things work.
Yes, I think this is one question you probably have heard a million times, and I'm just repeating it for the sake of brevity here. Should I sign the NDA before I tell the idea to investor? My answer is hell no. Investor is even going to look at you. But what's your take on this?
I've never signed an NDA in my life.
Hey, you got the answer. One very interesting question, and before we kind of try to wrap this up, do you invest in a team where everyone is not fully dedicated to the startup?
Not unless. So if this team doesn't become full-time with the investment, absolutely not.
Yeah. So basically, that is the contingency or a contingent that raising capital would mean that they're going to full-time work for the startup. That's something we look for.
So we need to be careful with generalization, but my rule of thumb is part-time doesn't cut it. Yeah. Obviously, sometimes you have configurations where you have a team and maybe you have something like a chairman, and the chairman or chairwoman is part-time, say, or something like that. That's not a problem, right? But the core team that's actually doing the work, they need to be full-time on the company, fully dedicated, because otherwise, you're pitching to me, hey, Jens, we're going to build you $1 billion to $10 billion like outcome startup, but I'm going to do it part-time while I'm doing my day job. I'm sorry, that's not going to work. It's actually fine to start a startup like that, but then you shouldn't ask people for money. I think that's the distinction. The companies that I'm looking to invest into, I want them to be very high growth companies, and unless the team is fully dedicated towards making this happen, it's not going to happen, and therefore I wouldn't be interested.
And there is one last question which I have, which is around valuation. So how do you value a pre-revenue company? How venture capital or seed investor, I don't know, the next part of the question is not very clear, but yeah, how do you value a pre-revenue company?
You don't really. You basically, the best way in which it's more of a function of how much capital you raise, and then where that money gets you, and then what amount of money you would then be able to raise at what higher valuation. And it's effectively, you try to figure out as an investor, if they give them this much money, will they be able to raise significantly more money, say 6 to 12 months later? And is that money enough to get them there? So for example, I've recently turned away an investment where I said to them, how much did he try to raise? Oh no, it's not true. I didn't turn it away. I just said to him, you will need at least to make this happen, probably $2 million or 2 million euros, something like that. So unless the round is of that size, I don't see any point in it. So I don't mind your valuation, but unless we can, get this amount of money together, there's no point in pursuing this, because you won't be able to put the team together that will get you to MVP. And he completely agreed, right? So so it's more of a function, is this money enough to get the company to the next point? And then it's like, sometimes I just talked to a company today who said the minimum that they need is 6 million euros, seed capital. So what valuation is that? I don't know. It would be high, but it's really the amount of money that they need. Yeah. So
probably starting at 60 million.
Right? No, it's I don't know. Maybe you started whatever, whatever it is. Maybe you started at 12 million pre or whatever, right? But so that would be higher than the norm. But it's, but if they can get to the next inflection point, maybe the company is then worth 100 million, right? So it's suddenly you think, okay, maybe that's a good investment, right? I might get if I invest on a 20 million post money and the next round is 100 million pre-money, I might make on paper 5 times my money within a year. So maybe that's a good investment, right? Particularly because the potential of this company could be it's a $10 billion outcome, right? So both in the short term and the long term, the return profile actually looks relatively compelling. I'm just not the person to write a 6 million euro check into this company, but if that happened and there were good investors there, then maybe I participate in that. So it's a bit crazy, but it's quite an aggressive thing. So who knows? Huh?
Maybe you can help people get there, right, through your network, and that's what is.
So I need to sleep over whether I commit and help them raise the capital or whether I say no, this company is not for me.
I don't think you have an intrinsic responsibility to help somebody, but your network itself, the network effects that we talk about, they themselves kind of,
That's
and usually I think investors, especially the higher round investors, prefer a warm intro to a cold outreach.
It's a signal can help, for sure. Yeah.
Unless it is supported with data and history.
Good data is always better than no data. Yeah.
I'm going to pedal Dash, right?
That's fair enough.
All right, that's all we have time for. We've gone over by 4 and we really value your time. Thank you so much for making time for us and for our audience. I'm sure people loved it. I don't know how many people are watching on live stream, but this has been an amazing session. Very, very insightful. Thank you so much, Jens, and wish you a great evening ahead.
Thanks for having me.
Thank you.
Thank you.
See you. Bye-bye.
Bye-bye.
Bye.